Today, we'll be diving into the world of business development companies or BDCs, and comparing two of the most popular ones on the market, Ares Capital and Main Street Capital. For those of you who may not be familiar with BDCs, they are companies that invest in small and medium-sized businesses with the goal of generating income and capital appreciation for their shareholders. One of the key benefits of investing in BDCs is their high-yielding nature, as they are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. In today's video, we'll be taking a closer look at Ares Capital and Main Street Capital, two of the most popular BDCs in the market. We'll be comparing their investment strategies, portfolio compositions, dividend yields, and overall performance to help you decide which one may be a better fit for your investment portfolio. So if you're interested in learning more about BDCs and how Ares Capital and Main Street Capital stack up against each other, be sure to stick around for the rest of the video. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. We will start by comparing and contrasting two of the top blue-chip BDCs in the market, Ares Capital Corp., ticker symbol, ARCC, and Main Street Capital, ticker symbol, MAIN. Both companies have generated substantial long-term outperformance compared to the broader stock market, and the BDC sector as a whole. However, which one is the superior BDC? First, let's take a look at Main Street Capital's advantages. Main boasts internal management, which gives it a lower management expense ratio. Additionally, it has a superior long-term total return track record compared to Ares Capital. Furthermore, due to Main's stock price's vastly superior premium to NAV, it has the ability to generate growth more easily, allowing it to issue stock and reinvest it more accretively than Ares Capital. That being said, I believe that Ares Capital still significantly outshines Main right now. Here are 3 reasons why. Firstly, Ares Capital is better positioned for an economic downturn. Given the numerous recession indicators that are currently flashing, such as the sharp yield curve inversion, the banking sector turmoil, GDP growth numbers slowing to a crawl, persistently high inflation driving Federal Reserve tightening ever higher, and an ever-growing chorus of bearish outlooks being issued by businesses and highly regarded economists, it is prudent to favor more defensive business models right now, all else being equal. When it comes to evaluating Main versus ARCC in terms of recession resistance, this is really a no-brainer. Ares Capital's portfolio is more conservatively invested, with greater exposure to debt investments than Main has. This explains Main's superior total return performance over the long term, relative to Ares Capital. As Main's greater exposure to equity investments has fueled outperformance during the recent prolonged economic expansion. However, Main's greater recession sensitivity was displayed in Ares Capital's meaningful outperformance during the Great Recession. Ares Capital also meaningfully outperformed Main during the COVID-19 outbreak. Ultimately, I believe this to play out once again in the coming economic downturn. In addition to its recession-resistant portfolio, ARCC has another advantage over Main that makes it a better buy right now: a significantly better dividend yield. As an income vehicle, the dividend yield a BDC pays out is extremely important to determining its total return potential. ARCC currently offers a 10.5% forward dividend yield, significantly higher than Main's 6.9% dividend yield. Moreover, while Main's dividend looks very sustainable right now, so does ARCC's. ARCC's spillover income is over 2.5 times its current regular quarterly dividend rate, providing a cushion to support the dividend even in a serious recession. The safety of the dividend is also supported by the improvement in the investment portfolio's quality, with the average size of ARCC's counterparty improving significantly throughout 2022, particularly in Q4. ARCC's management highlighted this improvement on the Q4 earnings call, stating, "At year-end 2022, the weighted average EBITDA of our portfolio companies reached $275 million, an increase from $162 million at the end of 2021 and meaningfully above the weighted average from 5 years ago of $62 million. We believe this offers significant benefits to Ares Capital as we grow, as larger companies generally have stronger credit profiles as a result of more diverse revenue streams, broader customer bases and more experienced management teams. With a strongly supported dividend payout and an enormous edge over Main in the yield department, it is hard to see how Main will meaningfully outperform Ares Capital moving forward. Finally, ARCC's valuation is significantly lower than Main's, giving it much greater margin of safety as we enter a period of increasing economic uncertainty. Main trades at 1.5x its NAV while ARCC trades at 1x its NAV. This means that when buying Main, you are paying a 50% premium relative to ARCC's assets. While it is true that Main's expense ratio is a bit lower than ARCC's, this is not even close to being enough to compensate for this differential, especially when you consider the aforementioned point about where we are in the economic cycle. As a result, it might be expected that Main will suffer from multiple contraction as the economy sours, whereas ARCC should continue to trade at least in line with its NAV. In conclusion, while Main certainly has its advantages, including internal management that gives it a lower management expense and a superior long-term total return track record, I believe that ARCC is a better buy than Main at the moment. ARCC is better positioned for an economic downturn, offers a significantly better dividend yield, and has a much greater margin of safety due to its lower valuation. With these factors in mind, I believe that ARCC is the superior BDC and the better investment opportunity for those looking to invest in this sector. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.